Hey there, welcome to the final bar. Today, my guest is Tom Bowley from Earnings Beats, a longtime StockCharts contributor, helping us make sense of recent movements in the stock market. Also, a little look at volatility and how that's relating to the pullback that we've seen in stocks this week. Big rally today from the financial sector, which is pretty unusual. A beaten down sector, chronic underperformer, making new swing lows yesterday. And all of a sudden, you have a ton of bullish engulfing patterns today. So we'll take a little look at financials in particular. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the markets from a technical perspective, try to connect the short-term movements of what we're seeing today with the long-term trends, try to connect the flickering ticks of recent hours to the longer-term trends of recent weeks and months. You know, today was an interesting one. Yesterday was a sell-off after further distribution the day before. All of a sudden, you have this gap down, or certainly a distribution the first 30 minutes of trading, and it felt like this was just going to continue lower. Then all of a sudden, you get a reversal, and by the end, you're sort of flat around midday, around lunchtime, and then you finish in a position of strength. It was really driven by financials, consumer discretionary technology, and financials have been toward the bottom of the list for a while. So it's really sort of a change for some of those. And some of the charts all of a sudden in the short term have gone from looking like absolute dogs to potentially maybe something there. So I'll have to see if the longer term picture has changed enough to warrant some attention. Coming up on StockCharts TV, as I mentioned, we have Tom Bowley joining us today. He's a fantastic guest and a very thoughtful analyst. Next week, we've got three more to share with you. On Tuesday, the 19th, Todd Campbell. He's from EV Capital Markets in Boston. On Wednesday, the 20th, Doug Bush from ChartSmarter in New York. And then Thursday, Kim Sokoloff, also from the New York area, joining us for the first time on the show. Also on Monday, we have our next episode of Behind the Charts. Our guest there is going to be Matt Lampert. And again, Behind the Charts is an interview-style show, taking a little bit longer time, really getting into people's backgrounds, how they approach the markets. And I think if you watch those series of shows Behind the Charts, you're going to get just a playbook of how to structure your approach, how to think about the markets, how to understand different market activity in a way that you may not have before. So check that out on Monday, Behind the Charts. Our next segment is called Market Recap. And what I want to do is just focus a little bit on the returns today. We're going to dig a little bit into some of the breadth picture that has changed in the last couple of days, and then dig into some of the sector themes, because today was an interesting one with financials at the top of the list for the first time in a while. The S&P up, closing up just above 2850 to 2852.50, up just over 1% from yesterday's close. Mid caps up about the same, 1.1%, and then small caps down just a token amount, just over 1/3%, with the S&P 600 getting above 700. The VIX a little bit lower now today, around 3250, and the Nasdaq 100 finished about the same as the mid cap index, and as well as the S&P. We're going to get to the chart of the S&P in a minute. I did want to point out we're having a segment in a bit called Clipping Coupons, where we focus on the bond markets, on the fixed income picture and how that's evolved. The TLT actually up as well and gapped higher and moved higher, but then sort of distributed through the afternoon. And interesting to see both stocks and bonds finishing positive today. We're going to look a little bit at the chart of the TLT and how that's evolved, because it's pulled back to an ascending 50-day moving average, potentially suggesting some further upside from here. And that's the up move in the TLT coinciding with the down move in 10-year yields. Commodities stronger for the most part across the board. The GLD, the gold ETF, closing up almost to 163. That's 0.8% from yesterday. Oil finishing up strong as well, although energy stocks weren't dramatically higher. They were sort of a market performer, just a little bit under the market. It's financials and others that really drove things to the upside. When we look at a chart of the S&P 500, I'm thinking about, the general theme is this process of evolving from bear market rally to a sideways trend is what we've seen for the last 4 weeks, 4 weeks essentially, right? We rallied up to the 61.8% level. Since then, we've really not gone anywhere directionally, even though there's been a range. So you sort of have this uptrend and then a sideways trend, that painful third direction, not up, not down, but sideways. Now we have talked about a range from that 2935, 2950 level. That's the 61.8% retracement here. And just above there, that S&P 3000 level, which is meaningful for a couple reasons. The big round number theory, but also that would break above the 200-day moving average, which would be pretty significant. Broke down through that in late February. But now we're starting to establish 2,800, which is the low from about 2 weeks ago, as another sort of short-term support level within this range. And now you've got a pretty clear range given today's rally. And again, I'm eyeballing it a little bit. You could probably call this a bullish piercing line. We have an up day and the close goes at least halfway through the previous day's bar. Looks like we're almost right about there. So I think we could call it that. But sort of a short-term bullish candle configuration. This is after we had the bearish engulfing pattern a couple bars ago, suggesting lower lows. That's what we've seen. Now we're getting a short-term bullish candle. And if you look at a lot of the financial stocks I mentioned, bullish engulfing patterns all over the place there, suggesting short-term strength. So we sort of pulled back to a position of support. And what's great about this, the markets are never easy, but you won't have much easier of a time identifying a momentum shift, because one of two things will happen at some point. Either we break above 2950, we break below 2800, we confirm whatever move that is by following through the next day or two. And that I think we can assume that that's going to be the direction of momentum going forward. So now we're range bound. We need to see which way we break, and we'll start to look for clues from some of the different charts that we can review together. You know, I thought talking about a recap, it would be important to look at this chart. This is one we've talked about in our 3 and 3 recently a little more often, because for a while it was sort of a non-issue. The market was going higher coming out of the lows late March, and we had the cumulative advanced decline lines making the short-term pattern of higher highs and higher lows, or higher peaks and higher valleys, just this nice consistent uptrend. But if you look at what's happened in the last couple days, is all 4 of these, large caps, mid caps, small caps, and then that second one down is the New York Stock Exchange. So pretty broad universe of equities. All 4 of these now have broken down through trendline support. All 4 of them have broken down through the most recent swing low. That's the first time that's happened since the market downturn. So you're actually starting to get them to rotate a little bit lower. Now, these are not updated for today's close yet. So we had a bit of a bounce in stocks, finishing a little bit higher. So I think they come up a bit, but overall, I think the signal is still in play, which is suggesting some internal weakness. It's suggesting that the breadth picture has already started to break down. Usually what happens is the breadth will break down first, the broad index will break down second. The reason is because you'll have some individual names in there, because it's equal weighted essentially. You have some individual names that are starting to roll over a little bit before the broad index, right? People will go to the safety trade, the big mega cap names, which will hold up the broad index before, and the breadth indications will roll down first. You'll get the confirmation later from the S&P. So I think the breadth picture has now turned sort of short-term neutral to negative a little bit, suggesting some weakness and at the very least an exhaustion of this bear market rally that we've seen. I think the price of the S&P, if you look at just the value of the index and how it's evolved, I think that sort of confirms that thesis. In terms of sectors, as I mentioned, the XLF up 2.5% today. Consumer discretionary, technology both up 1.5% and 1.33% respectively. So it was certainly a step on the accelerator in terms of leadership today. Although again, this is one day along with a series of days is what really makes up a trend. So you can't draw too many broad conclusions from it. Only though I think seeing something like the XLF up in the gainers list is certainly an unusual reading that we haven't had recently. At the bottom here, we have consumer staples and real estate. Consumer staples, the only of the 11 S&P sectors finishing down on the day, and actually finished more toward the high. So everything sort of rotated back to the positive side by the end of the day. In terms of groups and leadership and laggership, I think it was interesting to note at the top, you have some of these recovery sort of themes like hotel and lodging REITs, furnishings, mortgage REITs, hotels, all in the top 10 industry groups. Also banks, and I tell you, it's not often that I've seen banks in the top 10 list of industries, so that's unusual. But also, miners and gold miners. I was interviewed this morning for the FACE program, part of Forex Analytics, their webcast series, and the host Dale Pinker was asking me about gold and precious metals, and I, looking at the chart of the GLD, it's one of the more constructive long-term broad asset classes I think you could find right now. And gold miners in particular, and Newmont Mining, which has consistently been one of the top stocks in our scooter rankings, continues to impress. And the fact that gold miners making new closing highs today, pretty impressive. So holding up very, very nicely. On the downside, you do have some other groups within materials like aluminum names and non-ferrous metals. Other notable places on the bottom here, defense stocks within industrials, tobacco names, which have been kind of an interesting group. They've pulled back a great deal and have been underperforming. So again, sort of not quite getting the follow through to the upside you might have hoped for at the end of April. They sort of reverted lower, while other things have held up a little better. But you also see things like personal products, which was in consumer staples. So along with tobacco, that's part of the reason why consumer staples down. Also food retailers and wholesalers weighing on the index as well. So kind of an interesting day, to be honest with you. I just want to finish up very quickly by just looking at one of the stocks, Wells Fargo. This is one that there's a rumor earlier today about Wells Fargo and Goldman Sachs starting some sort of partnership, some sort of relationship. These are the bullish engulfing patterns I'm talking about, where you had a big down day and then that's followed by an up day, and the open close range of day two engulfs the open close day of range one. On a candle chart, it's a big solid candle and a big open candle, short-term bullish. And what's interesting, this is just after Wells Fargo made a new 52-week low yesterday. So an interesting rally there from Wells Fargo to finish the day. And again, across the board, a lot of financials in a similar situation. That's our market recap for today. We're going to take a quick commercial break. Back with my guest, Tom Bowley. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller at StockCharts.com. Thanks for joining us on the final bar today. Wanted to remind you 2 ways to get a hold of us. Number one, the final bar at StockCharts.com is our email, and also on Twitter at FinalBarSCTV. As a reminder, tomorrow we'll do another mailbag segment. We'd love to answer one of your questions. So anything is fair game: a particular chart, a particular ticker, a theme, a market strategy, a technical indicator. Anything is fair. Just shoot in an email to us or on Twitter, and we'll love to answer your questions in our mailbag segment tomorrow. Want to bring on my guest, a familiar name, face, and voice to many of you, Tom Bowley from Earnings Beats, a longtime Stock Charts contributor, fellow host on Stock Charts TV. Tom, welcome back to the show.
Thank you, Dave. It's great to be here. I hope everybody out there staying safe.
You as well, Tom. And obviously, it's a fascinating time in the markets. I was talking to some of our guests earlier this week. I mean, from an academic perspective, it's fascinating to see how these phases have evolved. And as we're thinking about, the S&P 500, I'm looking at, a market that has rallied up to rallied up to resistance, this huge bear market rally. And now we're sort of in this fluctuation period. First chart you asked me to bring up involved accumulation distribution. What is your toolkit telling you about the current environment where we're headed?
Well, this has been a really interesting period in our history in the stock market. I mean, if you think about it, a pandemic, I can't point to another time in history that I've gone through a pandemic. I don't think there are too many out there who have. So, I found that the market has traded a lot differently since the early part of March. And on this chart down at the bottom there, you show the accumulation distribution. And I would just point everyone to where the S&P 500 was on that initial low at the end of February, which was down just under the 290 level. And then we bounced and ultimately made that second low, that big low in the middle part of March, down around 220. And when you look at those two lows in price, if you look at the accumulation distribution, which really is an indicator that tells us a little bit about what's happening during the trading day. It doesn't focus on what happened at the opening gap. It doesn't care about what happened or where we were the day before. I think that accumulation distribution staying above that late February low was really important, because to me it said that even though the price action was going lower, that we had willing buyers during the trading day. And so for us at Earnings Beats, what we've been doing is I actually created two different chart lists. One was a strong accumulation distribution chart list, and another's a weak accumulation distribution chart list. And what I've found over the past couple of months is we really have two different kinds of markets. We have a pandemic, we have a paradigm shift, and as a result, we've got Wall Street pouring money into one area or several areas of the market, but completely ditching other areas of the market. So it's really been this divergence that's taken place over the last couple of months. So I thought that was probably the first point of this whole thing, was the fact that the AD line held up. And then just recently, as we've been trying to move higher, and you show that double top on the S&P 500 from the last couple of weeks, look at the AD line. AD line's been going down. So now the market looks like it's, at the beginning of this week, I started getting a little bit nervous, and we've definitely pulled back. I'm not sure we're quite done yet, even though we had a nice day today.
And it's interesting that the accumulation distribution indicator here, that's, if I remember right, this is a Mark Chaikin, I think, design, which was, it's looking at money flow, right? It's looking at volume based on where we're at relative to a range. So that indicates sort of weaker volume during this last couple week period, right?
Yes, it is definitely. Well, there's a volume multiplier,
Right.
but it looks at where you close during the day relative to where you traded during the day. Yes.
That's exactly. So I remember thinking of it as a mix between like stochastics with a volume component almost, right? So it's looking at where we're at relative to a range, and then with the volume multiplier.
Yeah, except the actual accumulation distribution number really is kind of like, it doesn't matter. You see there's no scale on the right side of it. It's just
Right.
adding or subtracting this random amount every day. But I think
Got
it does still give us good signals.
Very, very good. Now, the question number two is obviously we were in a period of unprecedented volatility, and then an unprecedented drop in volatility from February to May. How do you think of the VIX relative to what you're seeing on the S&P?
It adds to my bullish argument. I'm very bullish, and I'm talking about longer term. I think we're in a secular bull market.
Sure.
Does that mean we can't go down again? No, it does not mean that. I think that there's still the possibilities, a lot of uncertainty in the market, and there's still fear in the market. I mean, anytime you've got the VIX sitting in the 30s, if you look historically, a VIX in the 30s is pretty substantial. I mean, that's when you're not quite sure we could get an impulsive bout of selling at any point in time. The only thing I would mention about the VIX, and this was another thing that I thought we might have a little problem this week, is intraday on the VIX. Just recently, we went down to about 26. And if you look back at the end of February, early March, some of those initial pullbacks in the VIX went down to 25. So I felt like if the bears were going to really, hold their ground, it was going to be when the VIX got down to around 25. And that's exactly where we've bounced from on the VIX. And that's created the anxiety that's led to some of the selling this week.
Very interesting. So when you're looking at the VIX, when you're looking at the S&P, and I know from speaking to you and following your work closely, Tom, I mean I know you're long-term pretty constructive on things. Is there something that you would need to, or that you would see on a chart of the S&P, or is it from the VIX or wherever, that would suggest to you, you know what, this is going to be a deeper slog, bearish pattern than I ever thought? Is there a certain S&P level that we would break that would convince you otherwise, or what indication, what signal, or is it a stock specific, sector specific thing? What would tell you that, you know what, this downside is going to be deeper and more painful than I might have expected?
Well, I will say first that I'm much more bullish the QQQ than I am the spider, because
Okay.
I think that there are areas within the S&P 500 that if you're diversifying in the spider, it's great if you're on the technology side, but you've also got airlines in there, and you've got a lot of, well, actually the QQQ I think has a couple airlines as well. But my point is that I think more of the money has rotated toward a lot of the components of the NASDAQ 100 than it has toward the general, the strength that we've seen in the S&P 500. So I think the S&P is going to lag. And being a former practicing CPA, the growth in earnings, I think, is really important in a low interest rate environment. And those companies that are being represented on the NASDAQ 100, many of them are growing their earnings pretty solidly, even in this pandemic. And as a result, I think they're going to command some really high multiples. So I'm bullish longer term. I would be watching maybe on the S&P 500. I think we could get as low as 2,600 if the market really started to roll back over again. I don't know if we're going back that low. I think we're going to consolidate, and I look for the market to break out again.
Tom, it's a great take, and some very. I love the simplicity of the charts, the simplicity of the message, but all the thought and the detail that goes behind it. It's really well received. Tom Bowley, thanks so much for coming on the show again. We appreciate it.
Always a pleasure, Dave. Thank you.
This is Tom Bowley joining us from Earnings Beats in the Carolinas, and again, hope Tom stays safe and his family and everyone. But a great take, and again, what's interesting, there are a lot of tools like accumulation distribution that I find a lot of our users don't necessarily take as much advantage of. That's a great way actually measuring, I guess, validity or the strength behind some of the moves based on the price range, based on the volume picture, and seeing how those trends evolve based on relative to that accumulation distribution. So great take. Next segment we're going to move on to called Clipping Coupons. This is our regular look at the fixed income markets. As I mentioned earlier in the show, I want to say I was on a guest spot on Forex Analytics' show earlier today, early morning actually for us here in Washington State, but it was fun, and had some questions about the bond markets. And the question was, essentially, how can bond prices continue higher given XYZ, all these conditions? And, to be honest with you, I think the fact that you're watching the show, the fact that you're most likely using StockCharts tells me that you probably have at least some familiarity with charts and understanding the value of following trends and price, right? I have found that the reasons as to why price will evolve in a certain way is usually very clear in the rearview mirror. I would never invest on what should happen. Invest on what has happened. Invest on the trend. Follow the price, because that is truth. That is reality. That's what has actually happened over time. And if you look at the TLT, what's compelling to me is, while something like the S&P 500 sort of testing support, sort of rolling over, seeing weakening breadth than elsewhere, with something like bond prices, you're actually seeing more of a constructive pattern. We had most recently a higher high. This was in mid-April. Then a pullback, and it sort of retested that same support level just around 163 or so. And this lines up with the low that we saw in early April, sort of retested that on a closing basis, almost identical levels. We had one day below there and then sort of bounced back. And into this week, it's now lining up as a pretty good bounce above, off of its 50-day moving average. So if you look across a bunch of things, with the exception of things like, the Qs, there are very few markets, very few, especially at a broad asset allocation level, that are above two upward sloping moving averages. And that's what you have with bond prices right now. Now, all you need to do to change this picture is start breaking below swing lows. So if we break below 162.50, which would line up with these lows over the last 3 or 4 or 5 weeks, then it would certainly change the picture. All of a sudden, you're starting to get a lower low, a lower high, and things are starting to distribute. But at this point, most recently, the TLT became extremely overbought. This is in early March when all the bond prices went completely whack-a-mole with stocks selling off so much. There's a lot of disconnection in the markets before things sort of settled back in. But if you look, even in the pullbacks, the RSI has never really gotten below 40, and that's more characteristic of a bullish phase. What's interesting is on the rallies, though, most recently, it's not gotten above 60 either. And so it really tells you we sort of remained in this 40 to 60 neutral range. And that's sort of what bond prices have done. As much as it feels constructive, it's still essentially been sideways for the last 5 weeks or so. So, again, I would look to see if this resumes, if prices are able to break higher. If you ask the question, can prices go higher because yields are so low? I will always remind you, don't confuse the bottom of the page with support. Just because yields have gone down does not mean they can't go down even further. I put this image of someone diving off the cliff a while ago, and I left it on there because it still is a great visual for what actually happened. Right about here, I remember when we hit this blue line, the question was, well, how low could yields go? Because look, we're at extreme low levels. We're going back years. And the answer is we can go way lower than that. Theoretically, we can go even further, right? So I would not worry as much about we can't go lower because we haven't gone there in a while. We are at that sort of the phase where unusual 5-6 standard deviation things could certainly happen. And with yields, again, you see the opposite. You see 10-year yields not really getting above an RSI of even 55, nowhere near 60. It's definitely more in a bearish phase, a downtrend in yields. And again, until you see some stabilization there, there's plenty of further downside for higher bond prices. and lower bond yields. And at this point, I think that's what the charts are overall suggesting. Now, a lot of times the different bond ETFs, and there are a series of bond ETFs that you can follow. For example, the HYG, the LQD, the AG, the TLT, and these are all just focused on different parts of the bond markets. And just so you're clear, the TLT is looking at treasury bonds. So it's sort of the long bond ETF. The AG is looking at a mix of treasury bonds and corporate bonds. So government bonds and corporate bonds. LQD is looking at investment grade corporate bonds essentially, and HYG is high yield or junk bonds. So less credit worthy companies and their debt that they're issuing. So if you look at each of these ETFs, you'll get a bit of a different picture. And there was that story not too long ago, and this is the big gap up on the HYG when the Fed announced they would be buying high yield bond. The high yield bond ETF actually is a way of bolstering the bond markets. Since then, it's sort of come off a little bit. And I think the question now is, where to? And to be honest with you, you're sort of in that midpoint of this huge range. If you look at the February high, the March low on the HYG, we're about halfway of the way back up. And the question now is, which way is which? So I think with the HYG, it's similar to the S&P 500. You have a ceiling around 80, you have a low around 78. One of those needs to be broken, and we'll have to see which way we get the follow through. So that is our segment, clipping coupons. And again, it's just the goal is just to touch base with the fixed income markets, make sure we understand where they're coming from. And again, I think the positive trend in the TLT is still in place. A breakdown there, I think you have to reconsider overall. And just to finish off very quickly, I'll switch over to the Mindful Investor Live chart list, and then I need to wrap the show here with a 3 and 3. One of these charts is looking at a ratio of stocks versus bonds. Here we go. Ta-dum. So this is looking at the ratio of the spiders, the SPY over the TLT. As you can see, it's been favoring stocks for the last 4 or 5 weeks. This is after the March 23rd low. You can see the ratio going higher, meaning the S&P outperforming the TLT. Pulling back a little bit this week, and this is on stocks pulling back, bonds sort of coming off of their 50-day. If that continues, all of a sudden you get a bit of a rotation. You're back to favoring bonds over stocks. Has not quite happened yet, but this is one of the ratio charts I would be looking at just to get a sense of rotating between those asset classes. That's it for clipping coupons. We need to wrap the show looking at the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the difference between the 10-year treasury yield and the 2-year treasury yield. You call this the 2s-10s spread, something a lot of institutional investors look at to understand the shape of the yield curve. We didn't have time to get too much into it in our fixed income segment, but what this does is basically shows you the steepness of the yield curve. The steeper the yield curve, essentially the healthier the economic conditions, because banks are able to borrow at or lend money at a short-term rate and lend out at a long-term rate, and as a result, you get the spread between those two. And the steeper the yield curve, the more attractive of a business it is. Easier for companies to raise capital, et cetera, et cetera. You can see the shaded recessionary periods here, and that usually has been preceded by an inverted yield curve, if you've heard that phrase before. We didn't quite get there looking at this measure. We were sort of right at the point, but never quite got there. But what's happened since then is the yield curve has actually steepened in the last 6 weeks. So I think this is a key measure a lot of investors will be looking for to see if the conditions improve from here, or if we see the flattening that the trend that has been in place for a number of years. And sorry, this is a weekly chart. This is looking back for the last 6 months when you see this increase in the steepness of the yield curve. Chart number 2 is looking at breadth for cap tiers. We talked about this earlier in the show in our market recap. Just, I think it's really key, the fact that we've now had lower peaks in these cumulative advanced decline lines. We've now broken down through support for these lines, gone to a new swing low. And if that sort of continues down, I think that speaks to the weakness, the internal weakness of stocks that is not going to be reflected as much in a broad chart of the Qs or the S&P 500, but it shows you that stocks are breaking down. This is not updated for today, so we'll see if there's a bit of a bounce there, but that's one of the key charts. And then finally, we talked about some of the banks. We looked at a chart of Wells Fargo. How about Norwegian Cruise Line? Again, I'm not a huge fan of buying charts that are beaten down. I'd much rather buy stocks in good uptrends, but I see an RSI that is hitting support around 40 on these recent pullbacks, potentially indicating some uptrend there for cruise lines. Ladies and gentlemen, that's our show for today. I want to thank my guest, Tom Bowley from Earnings Beats, for joining us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.